Stocks explained simply, for absolute beginners. What are stocks? What is the stock market? And why are so many people scared of investing, even though it's one of the most powerful wealth tools ever created? If you've never invested before, this video is for you. We'll explain stocks and the stock market from zero, step by step, no jargon, no hype. By the end of this video, you'll understand what a stock really is, and how people make money with stocks, and the real risks, and why fear stops most people from getting started. A stock is simply ownership. When you buy a stock, you buy a small piece of a company, and when that company makes money, you participate in that success. That means you own part of the business, you share in profits, you share in risks. Stocks are traded on the stock market, and every stock has a price. That price is determined by just two forces: supply and demand. If many people believe a company has a strong future, more people want to buy the stock and the price goes up. If people lose confidence and want to sell, the price goes down. That's it. The stock market is simply a marketplace. It matches people who want to buy stocks with people who want to sell stocks. Today, this happens automatically through electronic systems, not through people shouting on a trading floor. The market's job is simple: find a fair price based on buyers and sellers. There are two ways to make money with stocks. First, price appreciation. You buy a stock, the company grows, the price increases, and you sell for a profit. Second, dividends. Some companies share part of their profits with shareholders. This payment is called a dividend. You don't need to sell anything the company pays you for owning the stock. If stocks can grow wealth, why are so many people afraid? Mostly because of bad personal experiences, horror stories from friends, scary media headlines, financial crises. People remember losses more strongly than gains. Yes, investing has risks. There are two main types. 1. Market risk. If the economy slows down, companies earn less. Stock prices fall across the entire market. 2. Company-specific risk. Sometimes a single company fails because of scandals, bad management, or mistakes. That risk only affects that one company. The solution is diversification. Instead of investing in one company, you invest in many. That way, one company failing won't destroy your investment. Your returns depend on the entire economy, not one business. An index tracks many companies at once. For example, the S&P 500 tracks 500 large US companies. The global market tracks thousands of companies worldwide. When you invest in an index, you invest in entire economies, not single stocks. There are two main investment approaches: active investing, trying to pick winning stocks and beat the market; passive investing, owning the entire market through diversified funds. Passive investing takes less time, costs less, and historically beats most active investors. Here's the uncomfortable truth: money in savings accounts usually grows slower than inflation. That means your money loses purchasing power every year. Stocks, on the other hand, grow with the economy. Despite crises, wars, and recessions, long-term markets have always recovered and grown. Short-term stock prices are volatile. Long-term economic growth is powerful. Investing isn't about getting rich quickly. It's about owning productive businesses over time. This was a simplified introduction, but a powerful one. The biggest risk isn't investing in stocks. The biggest risk is never starting. If this video helped you, hit like and subscribe.